So, can I welcome Fayaz? He's the Listed Product Sales Department, Global Equity Flow for Societe Generale. And if I can welcome Townsend, Executive Director and Head of Short Leverage and FX Platforms for ETF Securities. Perhaps you can introduce yourselves in terms of what your role is in the business and what the business does, Townsend.
My name is Townsend Lansing, and as you said, I'm Executive Director. I'm responsible strategically for our platform of short and leveraged products as well as our platform of currency products. I also sit on the management committee of ETF Securities and have responsibility for kind of senior level strategic direction.
And Fayaz?
Fayaz Badouraly from Societe Generale. What I do is essentially manage a range of listed securities on exchange, very much derivatives, so from warrants to structured products, and more recently, short and leverage ETPs.
So that's an introduction to the panel up here. I'm from Shares Mag, as you know. We do cover a lot more products around this leverage and short area, but also generally around the ETF and ETP product range, which is listed on the London Stock Exchange. There's about 1,600 products now that you can buy, and they vary from commodity ETFs and ETPs. There's indices, which are the bigger ones, and a whole range of products you can now buy, which means you get access to trackers for the Dow and for the FTSE if you want to do without actually having to buy the future. Quite a very affordable product. They have a bid offer spread. You can buy them through your broker. Every UK broker now lets you buy these ETFs. It's been a big day on ETFs today in our show. We had a room and other things. And what we thought we'd just discuss really is about this leverage area, which is key to these guys, and what sort of products you can expect to have. So you've both got differing products. Could you perhaps explain, Townsend, your range of leverage?
Sure, we have an extensive range of leverage, both products providing both short and leverage or long exposure with leverage. I guess when I say short exposure, essentially you're profiting if the price falls, and then you have long exposure, you profit if the price rises, and then we offer kind of a leverage on top of that. Our products cut across a wide variety of asset classes, so we have products that reference equity indices, commodity indices, one of our main focuses, and obviously currency indices. And then we also have products with different leverage factors, so we provide kind of on the short side -1 leverage, which means, for every 1%, say, fall in the share, the security goes up by 1%. And then we have leverage factors that are +2, -2, +3, -3, and +5, and -5.
And Fayaz, from your company, what range of products do you have?
So, as I mentioned, recently we have focused more on short and leverage ETPs, which are a similar product to what was described before. But if I could clarify the short exposure that you mentioned, on our side, the way that you can take a short exposure is simply by buying yourself, so you're not shorting, but you're buying a product that will short the market on your behalf, which means that whether it's long or short exposure, even if it's leveraged, one key element is the fact that you will not lose more than what you have invested. And because none of these products can have a negative value. So the worst case that can happen on an extreme scenario where you are long 5 times the Euro Stocks index, the worst case is that the product itself would go close to zero. And on the opposite way, if you are short the market and the equity market rises dramatically, that's the worst case again, where the product will go close to zero. But as opposed to the leverage offers to the retail investors in the UK via spread bet or CFDs, there is no margin calls possible even on short positions. So what we do, just to answer your question, is limited numbers of products. So historically, we have been launching a lot of different products, especially on the warrant side, where on one single underlying, which is the FTSE 100, we would have different strike level based on the level of leverage that you would need. We would have different maturities. Here on the FTSE, we have only 4 products, 3 times leverage and 5 times, long and short. These are open-ended and it's a much easier offer to understand from the investor point of view.
And talking about the limited downside, if you take out a spread bet, you've got probably unlimited losses if it goes wrong. CFD to a certain extent as well, unlimited losses. And that's something most investors don't really want to carry, but you can buy an ETF or ETP product that stops you losing more than you put in, which is great. It's also cheaper because you haven't got so much of a cost to get into them. A normal fee from your broker could be anything from £4.95 to £12, whereas you could be paying 0.25 through your CFD or spread betting provider. You talked very briefly, and mentioned very briefly about covered warrants. Obviously, this is a slightly different exercise, but do you have leverage warrants and short warrants as well?
By definition, a warrant is leverage because you would spend a premium, which is a small percentage part of your exposure. But the innovation here on leverage certificate is the fact that you are fixed to one, for example, 3 or 5 times leverage, which is much more easy to understand from an investor point of view. Once you have your scenario, you are expecting tomorrow the oil price to decrease by 3%, well, you know that a short product on oil will simply multiply by 3 or 5 this performance. So it's much easy to trade a short and leverage ETP than a warrant itself, where you have to take into account the volatility move, the time value, and to make sure that the warrant that you're buying is eligible to your scenario, it's adapted, and it will not lose too much of a value over time.
So if you bought a Brent short and it went down 3% in the market, 3 times one would give you a 9% gain on the day?
Over a day, yes.
On the days.
Over a day.
Clearly, the opposite's true. If you get it wrong, you have
Yes.
that leverage effect back down the other way. Townsend, can you, when you do these leverage products, can you put them in things like ISAs and SIPs?
Yes, definitely. I mean, I think just to contextualize why these products might be relevant for retail investors, and indeed talk a bit about that. I mean, they're clearly eligible for SIPs and ISAs. I think, a lot of people talk about kind of diversification theory and portfolio investment theory, and let's say 60-40, 3 to 5 years. And I think that's slowly changing over the last, say, 10 years, where people are beginning to kind of look at volatility in the marketplace, look at opportunities for tactical trades. And some people are saying, it's all good to have 60-40 with a 5-year investment horizon or even longer, but it might make sense to have 5% of my portfolio kind of segregated for, let's say, tactical trading, or perhaps even trading you might call higher risk trading. And that's where these products come into play. And a lot of times we see clients who do indeed in their ISAs or SIPs on a tax-free basis, or tax-deferred basis, if you will, ultimately, who are saying, look, I realize that I'm investing for the long term. However, I've got 5% of my portfolio, and I think there's a lot of money potentially to be made, or a lot of opportunity to be made in looking at tactically what's happening in the marketplace. Also, people might use these products as a hedge, for example. So as leverage levels go up into the 5 times, someone might say, okay, look, I'm a long-term believer in the FTSE 100, but over the short term, I think there's potential disruption on the downside, and I might therefore buy a short product to hedge myself for that disruption while maintaining my long exposure in the other equities. So these products really are suited or kind of targeted towards tactical, short-term trading and hedging opportunities in that respect.
So particularly for, say, a pensions or SIP, you could buy just for the UK, a FTSE index ETF, leverage and loan leverage, without having to buy the individual stocks, and your investment will just track the FTSE up and down. So it's actually quite, not say lazy by any means, but an easy way to invest in the whole of the UK FTSE 100 in one transaction rather than buy 100 stocks.
Definitely.
So FTSE over the years came up with different indices. The first one was the FTSE 100 itself, so the total return, which you would track under an ETF format. But lately they came up with what we call the leverage indices, which goes up to 5 times. And what we do is simply give you exposure to these indices. So we are not calculating ourselves the leverage. We give you exposure to these indices via exchange-traded notes.
And do your products track like for like the FTSE? In other words, if the
Yes,
FTSE
on a
goes up
daily
1
basis,
point,
yes.
it goes up 1 point. Or is there a cost implication?
There are obviously costs embedded in the product. I think, I will say just talk a lot about product structure. The structure of these products is probably more complicated than, say, talking about Apple shares. I recommend that you visit any of our websites, whether it's SocGen's website or in fact, we actually have a website we work on together as well that provides a lot of educational information about the structure. But yes, indeed, I mean, these products, they track, for example, the performance of the FTSE index on a daily basis. So if it goes up 1%, you will see the corresponding 1% or levered move, 1% times your leverage factor in the underlying product.
And I suppose depending upon your level of risk, you would take a different type of product, different leverage or non-leveraged product, depending on your risk profile.
Definitely,
really.
I think so. I mean, look, obviously, depending on your conviction, your risk profile, how much you want to put in. If you have a very high level of conviction on the short oil trade, you might think, okay, I really tactically think the oil is definitely going to go down over the next couple of days. I'm going to look for a 5 times product, something like SocGen might offer. And you can, if your trade view is correct over that short period, you can obviously see 5 times the percent change in the relevant oil index.
Or you can see the exposure differently and saying instead of putting £100 in a long trade non-leverage, I can put only 20 on a 5 times leverage as well.
And that's fundamentally the way leverage works. Agreed. Yeah.
Because it gives you have to put less money in to get the same effect.
Yes.
So it gives you a cheaper entry point, doesn't
Yes.
it? Would you advocate a sort of a balanced approach to leverage? I know leverage is quite a difficult thing for a lot of people to get their head around, actually, this multiplier effect, but could you do a balanced portfolio if you're looking for sort of longer term investor and you're sort of a bit of equity, a bit of commodities, a bit of other areas as well?
You definitely could. I think with our products, you would need to have a rebalancing strategy to do that kind of thing, where you're constantly buying and selling the product to make sure you achieve your targeted exposure. Again, I think the majority of investors, especially in the retail space that we work with, look at these as tactical opportunities, kind of for shorter term trades. This is not something, and I will say this right, it's not something to buy, stick in your portfolio and walk away from and never look at for a year. That is clearly a risky approach to these products, the way they're structured and the type of leverage they're offering. But if you're saying, okay, I have a view, and that view is over a certain time horizon, then yes, you could, of course, build a view across a wide variety of assets. So if you said you had a view on the FTSE plus oil plus the GBP, you could obviously access products across all those. But of course, I would recommend that you look at that view in a shorter term, maximum 3 months, and even pare it down to a matter of days or weeks.
But again, using a usual broker, you can put a stop loss in place. If
Yes,
you are
of
worried
course,
about
yes.
the volatility of the marketplace, especially when you've got 3 or 5 times leverage, there's quite a small movement in the market can be a big movement in your account.
That's correct.
Is to put some stop losses in place just to protect yourselves. It's not a sophisticated product by any means, but it does give you that extra bang for your buck, as they say. You can be a small investor but still get the benefit of scale.
Indeed, definitely.
Shall we open up? Anybody got any questions at all? Can't see any hands. A gentleman just down here in the middle.
Excuse me as I have a look at you in the light.
Hello.
Hello.
If you have leverage trading, there's always a cost of money because effectively you're borrowing it, aren't you? If you do a 3 times the FTSE, you're effectively borrowing money to invest that. How are these costs reflected in the returns you get, or how do you? How does it work?
It's generally reflected actually in the index construction. So as you were saying earlier, FTSE have built the index for us. That's actually a leverage index, and that will embed the implicit cost of carry, if you will, in the actual index performance. I don't know if you want to say anything to that.
Everything was said really. One good news by the fact that FTSE is calculating that level of fees for us is in case of stress on any specific financial institution that you are buying the product from. Let's say you're buying from SG and SG has issues to borrow the USD or the GBP. Here you're safe because the borrowing cost is included on the index calculation itself. The cost for tracking this leverage index is available on our website. For example, for FTSE times 5, we have a cost of 0.55% per year, so 50 bips plus 5% of collateral cost. However, as we mentioned, it's very much a day product, a daily trading product, so we are not expecting you to pay this level of fees, which means that you would have to hold the product for a year. So it's pro rata on base of how long you hold the product.
What is the spread generally? Let's take a FTSE one as an example.
It always depends on the individual product. I mean, obviously, certain products have more liquidity. Some of the ETFs that are offered on, say, the FTSE have spreads that range from 15 to 20 basis points. Some of the less traded products, the spreads go up. Of course, it really is a question of, when you're trading, how much liquidity is in the product given. But I think the spreads are similar to what you see in other ETFs.
Yeah.
And those, I think, range from anywhere 4 basis points up to say, 20, 25.
They're highly liquid. You can get in.
Yeah, no, definitely. I mean, they're meant to be, because they're exchange traded, and because we obviously all with Societe and ourselves, we work with a lot of independent market makers who are in the actual market, in the secondary market, providing liquidity. You do see spreads that are very reasonable for the type of product you're trading.
Any other questions from the floor at all? Over there? Lady.
Is it possible for a private investor to buy an option?
As far as SG is concerned, we list a range of covered warrants which have exactly the same payoff as an option itself. So we have a cross-asset range. As I mentioned, we have, as opposed to the leverage ETPs, we need to have many different warrants available for you to invest because of the different maturities and strike levels. So you can buy a warrant, you cannot short sell it. And that would be the retail version of an option.
There are option providers out in the UK. They generally aren't the normal broker, but you can buy and sell options, traded options on stocks and indices in the UK. It's not a huge market for retail investors because there are such other leveraged products such as CFDs and spread bets when you can get the same sort of effect. Probably cheaper than going to the option market, but there are option providers, Options Express, and a whole host of people, and Barclay Futures, who do options in the UK. Any other questions, anybody? Looking around, can't see anybody's hands up. One more. That'll be our last question, I think.
I know one of you have mentioned that it's a very short-term trading thing. What are the charges like then? Because I've never really understood that. If we work from an annual basis, an ETF would typically be 5 to 90 basis points. What would it be if you're going to hold it for a week or 2 weeks for a leveraged ETF?
You would just prorate that. So you would take what we don't generally list the annual charge, although sometimes we also list the daily, and you would divide by 365 and then multiply by your holding period. So it just works essentially. All ETFs, even ones where they say it's a say a 5 to a 90 basis point annual charge, those charges are always more or less calculated on a daily basis and deducted from the value of the NAV, and so you can obviously prorate the cost based on your holding period. So the best way to do it when you're looking at it is, because most of us do tend to disclose the MER or the TR, if you will, on an annual basis, is then just to simply divide that by 365 and then multiply how long your holding period is.
But it's not something that comes out of your physical account, your broker. It comes out of the...
It does. It's embedded in the value of the product
yeah.
itself. So you'll just see the value of the product decline by that amount of small basis points per day.
Unlike a CFD or a spread bet, well, they'll take money out of your account
Yes.
every night,
Yeah.
0.2, whatever it is, or carry charge. This is actually within the product itself.
Yes.
Good question, though. Thank you very much indeed, both of you. Thank you for
Thank you very
taking
much,
part.
everyone. Appreciate your time.